Think you're not financially ready to be investing in a property? What if I told you that your financial situation or your credit score is not reason enough that you are not investing in a property right now?
Sounds crazy, right? Waiting until you are financially ready to invest in your first property is one of the biggest mistakes beginner property investors make.
By the time you would have saved up that 20% of deposit, you would have missed out on massive deals, years of appreciation, and years of cash flow.
Today we are going to show you why being financially ready might be a myth. And if all these other things are in order, you can start buying your first property today.
We've all heard someone say that you can never go wrong with property, or it's always better to buy cash. While there's some truth to that statement, that's only one side of the story. What often gets overlooked is the tax benefits that come with buying a property through financing it from a bank.
The rental income you earn is subject to income tax. Well, that's not a surprise. Here's the game changer. You can deduct the bond interest, which will deduct how much you should be paying towards tax. This means you will keep your money while you are able to grow your investment portfolio.
Now let's be honest, how long will it take you to save up the full purchase price of a property when buying it through cash? For most people, the timeline is painfully long, and during that time, the market keeps on moving without you.
Finally, leveraging finances is one of the smartest ways to grow your property portfolio faster. By using other people's monies, the banks, you can start building wealth now instead of waiting for someday. So it's not about just owning your property, it's about unlocking your financial freedom.
So the first financing tool when applying for an investment is a cash flow based lending, otherwise known as specialized property financing program. So in South Africa and also globally, this approach is used for multi-land or commercial properties rather than your single home that you'll be living in. So here's how it works. Instead of looking at your personal income and affordability, what the lender will then do is look at the potential income of which the property can generate. Instead of looking at primarily your personal income and your credit score, what the lender will then do is that they will look at the potential of the property itself when it comes to income. Before the loan is granted, they will look at occupants' rental income and operating costs. If the net operating income can cover your loan repayments, often using debt service coverage ratio, they will approve your financing even if your personal income is modest.
Various organizations offer specialized property finance options for specific investment scenarios. An example of such financial institutions is TUHF. If you're looking at investing in income generating properties, especially in urban areas, TUHF is one of the standout institutions to consider. TUHF specializes in cash flow based financing, meaning they focus less on your personal income and more on the potential of that particular property. They assess the rental income, operating expenses, and the overall profitability of that building, making it easier for entrepreneurs or first-time investors to break into the market. They're particularly passionate about urban renewal and in South Africa's inner cities, helping transform underutilized properties and helping them to become more profitable.
Pro tip, if you are planning into investing into a multi-let or the urban inner city, TUHF could be for you. If you are looking to scale your rental property portfolio, ABSA is one of the major banks that focuses on actively supporting investors through both small-scale rental development and rental income-based lending. They go a step further through using both the current existing income and future potential rental income to strengthen your affordability when applying for a home loan. Here's how it works.
If you are buying a property that already has tenants and valid lease agreements, ABSA will include that existing rental income when they are doing an affordability assessment, as long as those tenants are expected to stay under those same conditions. Using rental income from a property that you already own. If you're already owning a property that has tenants that are already paying, then ABSA might also consider that for your affordability assessment.
Future rental income. Buying your second or third property, even if the property doesn't have tenants in as yet, ABSA can include a percentage of the related market rental income. This means that you do not have to wait until the property is fully tenanted. Therefore, this allows you to invest in sooner. This kind of flexibility is a game changer when it comes to first-time buyers or first-time investors, especially those building their portfolios through small-scale investment properties within the townships and urban renewal areas. Pro tip: if you are planning to converting your yard or back room into an investment or buying the next property as an investment, ABSA's SSRD and rental policies can make your journey faster and easier.
Now here are some good news. Really good news. If you qualify for the next one, you don't even need to pay the money back. It's called the First Home Finance, which is a once-off subsidy given by the government in order for you to use for your first home that you're purchasing. This program was previously known as FLISP and is designed to make property more accessible, especially for the first-time buyers that fall in the middle class income bracket.
How does it work? So this subsidy can either be used for your attorney costs or as a deposit, and this will ultimately result in reducing your monthly repayments. But of course, there is a criteria that you need to meet in order for you to qualify.
Here's the criteria. You must be a South African with a valid ID, or you can be a permanent resident in South Africa with a valid permit. Secondly, you need to be over the age of 18 and be able to sign a contract. Thirdly, you must be someone that has never owned a property. Number 4, you must be someone who has never benefited from any government housing program before. You also need to have an approved home loan from the bank, which is accredited by the National Credit Regulator. And finally, the household income must be between 3,501 and 22,000 rands per month. If this sounds like you, then definitely look into the First Home Financing. This is one of the free chances to assist you to enter the property market. Now here's a pro tip. When you apply via a bond originator, because they know the characteristics and they know how to apply on your behalf to increase the chances of you getting accepted for this financial grant.
Bank financing. Let's start with the most common one. So traditional bank financing, those are the ones that we are most common with. So you will be applying either directly with a bank or through a bond originator. Now, the amount that influences your deposit is dependent on a few factors: the type of property that you are buying, your financial affordability, and most importantly, how much of a risk is your bank willing to take when it comes to partnering with you financing the property.
For standard residential properties, you can often qualify for 100%, which means that no deposit for you. But when it comes to multi-let properties, that's when renting out multiple rooms or units in the same property. The bank usually sees this as a higher risk when you're looking at it from an investment perspective. In this case, they might require a 20% deposit. Now here's a pro tip. Because bond originators have applied to various banks, they understand their criteria and what are the chances for you to get approved by that particular bank or multiple banks. So what I would say is that go and apply via a bond originator.
Partnerships and joint ventures. So this is another creative way of financing your first property deal, especially if you don't have the finances or credit on investing in that big property deal. So therefore, joint venture does give you that opportunity to partner up with other individuals. So what does that actually mean?
A partnership is when two or more people come together to buy a property. Each partner brings something to the table. This might be via cash, access to money, or having your skills and also time. The idea is to share costs, responsibilities, and profits. For example, you might have a friend that qualifies for a loan but does not have the time or the experience to invest in a property. But on the other hand, you have the experience and the skill to invest into that property. In that case, we have a situation where both parties can actually come through to invest in one property.
So these are the pros of a joint venture or partnership. Shared financial burden. Therefore, the total amount of the bond or the deposit or other costs that can be associated with buying the property or even maintaining the property can be shared with your partners. So therefore, this eases the financial burden because it is spread amongst yourselves. The second pro is combining the strengths. As they always say that two heads are better than one. So what can happen is that one of the partners can have good financial skills when it comes to running the numbers. The other partner can be really good when it comes to maintenance or actually building. So therefore, when these two come together, that's a masterpiece.
Now, these are the cons of investing in a property via a partnership or joint venture. Shared decision making. You can't make decisions by yourself. You have to wait for your partner in order for you to reach an agreement in terms of what needs to happen with the business. That can sometimes slow things down or create conflict if both of you are not on the same page. The second con is to split profits. You will not get 100% of the profits that come through. Everything, rental agreement, appreciation, and tax benefits get shared according to the agreement when the business started. Now, here's the pro tip if you're going to go the joint venture route. Make sure that you put everything in black and white before the project starts. Draft a partnership agreement that explains the roles, the responsibilities, the exit plan, and how profits will be split. That protects everyone and keeps everything professional.
So if you are a first-time property investors wanting to start your journey today, make sure that you hit the link below and book a Zoom meeting with us so that we can add more value to your journey.
Now that you've got the financing right, here's a video for you to watch on what to do for your first-time rental property.